Thank you, Mr. Chairman. Mr. Williams, in your testimony, you talked about the QM rule and the debt-to-income ratio and low dollar, high cost loans. I was just thinking as you were saying that, and then you mentioned about people not able to access home ownership and stuck with having to maybe continue to rent. And I was thinking about Hart, Texas. And I was wondering if, that little single mom that maybe works at the Hart Cafe part-time, and she has another part-time job, but she's saved up some money over the years, and she comes, and she'd like to, quit being a renter and wants to be a homeowner. If you can't make that loan, who's going to make that loan to her?
Congressman, I can't say who will make that loan. We couldn't make the loan, or we'd have difficulty because it's a small community. There's going to be non-conforming, it's a non-conforming property because it's not an urban. We wouldn't have comparables for the appraisals. It'd be a very difficult loan to make. We'd try to find a way to do it. We do offer portfolio lending services, but under the QM rule, we could not make a qualified loan.
And so particularly, I believe in Hart, you're the only bank, is that correct?
Yes, sir, that's correct.
Yeah, and in a lot of communities around the country now, there's just one community bank left. And so if there's not a community bank left to make those loans, whether it's a mortgage loan for that single mom or production agricultural loan, it doesn't leave a lot of choices, does it?
No, sir, it doesn't. And I have empirical data from our State Association of Texas where we went out and solicited feedback from our member bankers, and 25% of those banks remarked in the rural markets if they were not there to make the loans, no one was there to make the loans.
Thank you for that. Mr. Miller, I think you mentioned in your testimony about recently one of the credit unions in Corpus Christi, maybe when the CFPB's final rules on making remittances was put in place. I think that about 150 members of the credit union kind of lost access to be able to utilize those services. What other kinds of choice limitations are going on in the credit unions that are beginning to limit the products that members are able to access?
Well, the remittance rule is a great example. Well-intended legislation. CFPB wanted to give people a chance to shop for a half hour after they placed their instruction to send a wire, an international wire. I don't know anybody that shops after they've made a decision and walked into a non-Wall Street bank or credit union and said, oh, I'm going to go shop around and see if I can save $10 on my international wire transmittal. Most people do their shopping before they walk in and make a decision. So that's our opinion on the remittances. On QMs, we've turned down 50 members that couldn't get a home loan because we're afraid of that regulatory scrutiny. And what that's going to do is it's going to force fewer and fewer choices for the consumer. They're going to pay more because when there are fewer choices, markets are efficient. So whoever gets that business is going to charge a little bit more. And fewer people are going to enjoy the benefits of home ownership, which I know has always been something the members of this committee are pretty passionate about, letting people that qualify to own a home, So whether it's credit cards, whether it's car loans, whether it's personal loans school loans, there's all kinds of the same thing's going to happen in virtually every category of lending. Fewer choices, higher prices, fewer jobs, fewer banks and credit unions that are generating their own jobs to create cascading impact on their local economies, fewer business lenders, fewer mortgage lenders, fewer car loan lenders, and it's going to cost jobs, and it's going to be a downdraft on the economy. There won't be an explosion of toasters and mortgages. There will be an implosion of jobs and economic growth.
Thank you. Mr. Fenderson, you indicated that you have a relatively small bank, and one of the things that I think it's $60 million, is that correct?
That's correct.
And we've got the new Basel III capital requirements for small institutions that will became effective, I guess, January 1st of this year. So for a small institution, when you have to keep more capital, what does that do to your ability to serve your customers?
Yeah, I can speak generally about that. We are not a seller servicer, so we're not applicable to Basel III. But the colleagues I speak with across the country understand that will restrict, if they have to hold more capital, then they are not able to make as many loans, and it will make them decide on how they treat those loans, on whether they want to be in that business or not. In fact, I've heard of some servicers who are in fact getting out of that business.
I think
Time of the gentleman is expired.